Hello, and welcome to the Investing on the Go podcast. I'm Chris Sarley, and today we're joined by Hugh Grieves, manager of the elite-rated Miton US Opportunities Fund. Thank you for joining us today.
Thanks, Chris.
There's only one place to start, obviously, with what's happening at the moment. Obviously, the US Federal Reserve has already spent sort of exorbitant amounts trying to tackle the pandemic. Could you perhaps tell us what you think the long-term consequences of that spending might be?
I feel it's still pretty early. We really need to find out how quickly we get through this recession before we can really start thinking about the longer-term consequences. But if you think about it, if it is going to be a relatively short, sharp recession, then clearly there is a danger that the Federal Reserve and the US government as a whole will overstimulate the economy and be pushing too much money at the problem. So, clearly there is a risk that we come out the other side with too much money sloshing around the system, which is hugely inflationary. And the question then becomes, what happens the other side is how the authorities respond to that. Now, it may be that given the amount of debt that's in the system, that the authorities may be very happy or very comfortable with inflation running too high because, clearly what faster way is there to pay down debt than just to inflate it away? A lot of the time people are using World War II or wartime analogies. Well, what happened after World War II when there was too much debt? We had too much inflation, and that got rid of the debt. So, clearly there's a risk that the inflationary genie now is out of the bottle.
History has obviously shown that no US president has ever been re-elected during a recession, and we've seen unemployment figures skyrocket in recent months. Do you think that COVID-19 will inevitably impact the result?
I first of all, to be careful looking at the headline inflation figure. You get these figures of 15, 18, 20% unemployment. This isn't structural unemployment. These people, in theory, do have jobs to go back to when they come off furlough. So, how they feel about that and how that affects their voting intentions is not totally clear. But certainly when you look at how Trump has handled this crisis overall, he hasn't really put a foot wrong in the same way that perhaps Bush Jr. put a foot wrong with Katrina in New Orleans, or other presidents have made mistakes in the past. But I think if he can come through this and show or get the country through this very quickly, then it will put him in a stronger position, clearly. Whether that is actually strong enough to get him back into the White House for another 4 years, though, is questionable. I don't think he was going to win anyway. I'm not sure that this really changes the result, but it might make it closer.
We've seen the stock market fall significantly in the past few months. Do you think we've reached a bottom now? Are you optimistic? If so, just tell us why.
Well, that's a $100 million question, isn't it? In terms of the sell-off that we've seen, really, I think we've seen three sell-offs, and let me just explain that. First of all, obviously, was the virus sell-off that we saw. Secondly, we had the oil price war between Saudi and Russia, which caused a second big leg down. And then thirdly, the two of those two combined to push up the VIX, which is the volatility index, to all-time highs. And the reason that's important is a lot of hedge funds, risk models, there's a lot of risk parity funds that rebalance their allocations all based on the VIX. So if the VIX goes up, a lot of these funds will sell their equity holdings, which drives the VIX up higher. So what you end up with is a sort of negative feedback loop where more selling creates selling. And I think that the third big leg down that we saw in last month was all driven by that. Now, that is all done now, which gives me confidence that that was an artificial low caused by the plumbing in the market. I don't think that repeats, so I don't think we get back down to the lows that we saw a month ago.
Okay. So you've got an element of optimism there. Have you been using the steep fall in markets to add to some of your existing holdings at perhaps attractive prices?
So we were very fortunate in January and February, we were doing nothing but selling as the markets were ripping higher. We had stocks hitting price targets, so our cash position built up to 11% of the fund. So as the market started falling again, it's much easier to reinvest that money back into the market rather than sell things to buy things. But yes, we've been using it to add to existing holdings and also to buy a lot of new holdings companies that we've been admiring for years and years, but never had the opportunity to buy in the past because they were simply too expensive. And now with the sell-off that you saw last month, a lot of those companies came back to levels that are attractive where we can buy them with a good margin of safety. So yeah, we've definitely been taking advantage of this sell-off. And this is the opportunity where you rebuild the fund back to, you upgrade the quality of the companies in the portfolio to build the performance for the next coming weeks, months, and years for investors.
You mentioned rebuilding the portfolio there, right? I believe you recently mentioned that you're sort of the most excited you've been about smaller companies for the first time in years. Could you maybe give us a bit more detail on that and what the attraction is there?
So the Miton US Opportunities Fund is a multi-cap fund, so we can invest throughout the market cap spectrum from the largest to the very smallest companies. For the last couple of years, we haven't had any holdings in smaller companies, and clients have often asked, why is that? And we've said, look, we're clearly coming to the end of a cycle. We don't know what's going to cause it to end, but you don't want to end small caps coming into a recession because they do badly. And that's exactly what's happened. The Russell 2000 small cap index has massively underperformed the S&P 500. But what we have always said to clients is, at the depths of the next recession, we will be significantly adding to our small cap weighting within the fund, because that's the time when everyone hates small caps, that you get the best opportunities to buy some wonderful companies at great prices. And we've really been taking advantage of that, as many other investors have retreated, raised their cash positions, and sold their holdings.
Are there a couple of sort of shining opportunities that you can maybe talk us through that jump out for you in the small cap space?
There's a couple of names that we really like. One is Bright Horizons Family Solutions, which provides, they operate in the UK, so people may be familiar with the business. It's providing childcare for working mothers and working fathers. It's a very profitable business. They're the largest provider in the US and the UK by far. Clearly they've been massively affected by the virus, as the nurseries have all been closed. But once it all reopens again, then the businesses can return to normal. It's a steady growth business. It generates a lot of cash. They have a very solid balance sheet. It's definitely going to be one of the winners for the future. Another option, another company that we bought into that we've admired for a long time has been called Site One, which is a landscaping supplies business. It sounds really boring, and it is. It's a really boring business. But clearly, in the middle of a recession, people are spending less on landscaping and gardens, etc. Share prices being hit hard. But as we come out of this, this company has a very small share of a very large market, and they're the leader by far, and will carry on consolidating the market going forward.
And you mentioned it earlier, but how has the oil price war between Saudi Arabia and Russia impacted the United States, and how do you see it ultimately playing out?
Yeah, it's interesting now that the US is obviously the largest producer in the world, but it's also the largest consumer in the world. Clearly, the slowdown in manufacturing triggered by the slowdown in the energy complex will hurt. But there's also the offset to that, which is the US consumer will basically get a tremendous tax cut from lower gasoline prices at the pumps. So the net effect for the US is probably reasonably neutral. Certainly for a lot of other countries, especially in emerging markets, it's going to have a very dramatic effect. But I wouldn't expect the oil price to recover anytime soon, because this isn't just a demand shock, this is also a supply shock. And as long as Russia and Saudi want to keep on fighting it out, there's going to be too much oil in the world. That's going to keep the price down. And
technology stocks, and in particular the FANGs, led the last bull market in the sort of aftermath of the credit crunch. Given they're some of the largest companies in the world today, do they still have the growth potential to lead the next bull market, or will others take the lead? And does that affect the US?
Well, it's incredible that now the 5 largest companies in the US, so Microsoft, Apple, Amazon, Google, and Facebook, now make up 21% of the S&P 500 index, which is the highest concentration we've ever seen. Now, the reason that those stocks have all done well, obviously, that's the fact that they've had tremendous growth is great, but also there's been a lack of growth elsewhere in the stock market, and you've had very low interest rates on the back of low inflation, which obviously boosts valuation. And the two combined have boosted the valuations of these companies. Now, going back to your first question, if the world looks very different on the other side of this, if we do have higher nominal growth and higher inflation, then growth will not be so scarce and interest rates will be higher. And both of those are significantly negative for growth stocks. And I think it'll be especially negative for these group of growth stocks because they're so widely overowned. Now, it's too early to tell right now, but this is definitely something that should be on people's radar screens. If the world is going to look very different in the future than it has in the past, then investors' portfolios will also need to look very different to how they have in the past.
So given we're in uncharted waters and we've never seen anything like this in our lifetimes before, how do you ultimately think this will play out? And in what direction do you see the economy eventually going?
Well, I mean, it's really fascinating because this is unlike anything that any of us have ever seen before. And none of us have a pattern or a model that we can refer back to. But, the way that we've been looking at this is it's like sort of running up and suddenly finding this chasm has opened up in front of you. And everyone's sort of looked over the edge and been scared out of their minds as they've looked down into the depths. But then you've had the Federal Reserve and the and Congress and authorities around the world have thrown all of this money, putting the US economy and other economies around the world into this sort of self-induced coma to get us across to the other side, where the ambition is obviously to wake all these companies back up and kind of carry on as if nothing has happened. So what they're effectively doing is they're building a bridge across this chasm that's opened up. And here we are, we're walking across this bridge towards the other side where hopefully everything has resolved itself in the future. And one day we'll look back on all this and go, what did we worry about? But here we are, we find ourselves on the bridge, hopefully getting closer to the other side. But sometimes we look down and we go, oh my God, this is really scary because of everything that is happening or could happen. And people are dying and companies could go bust and employment's going through the roof. But then we look up into the future and we go, actually, the future's not that far away. And the future hopefully is going to be okay. So as a stock market and as people in general, we're alternating between looking down and getting scared and looking up and getting hopeful. And I think that the closer we get to the other side, the less looking down we do and the more looking forward we do. And that's what's going to lift the market higher from here, is that increased confidence that we're going to get to the other side and everything is going to be okay.
Do you think now will be the sort of the trying period, the next 3 months, or will it be the next year?
I think it's going to be a lot quicker than that. I think either we'll discover that there's some therapy that works. We'll find out that the mortality rates are far lower than we think, or ultimately we get a vaccine sometime towards the end of the year. All of those things, and one or more of those will resolve the problem, and then we can move on and get back on with our lives. And maybe there'll be some things that look very different. But I think a lot of things will still look exactly the same as they did before.
That's great, Hugh. Thanks very much for joining us today.
Thank you very much.
And if you'd like to learn more about the Miton US Opportunities Fund, please visit FundCalibre.com. And while you're there, remember to subscribe to the Investing on the Go podcast. Please note that these are unprecedented times and markets can react very quickly to news. The views expressed are at the time of recording and could change. And remember, we've been discussing individual stocks to bring investing to life for you. It's not a recommendation to buy or to sell. The fund may or may not still hold these stocks at your time of listening.